Okay, let's get started. Good morning and welcome to today's Tuesday Market Outlook session. My name is Prakash Vijayanath. I am an analyst here at Options Play, and today I am going to be walking you through how we are viewing the current markets. So before we get on to that, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. So our agenda for today, as usual, we were starting off with the major equity indices, and we did see some breakdowns of key support areas here very recently for the S&P 500 as well as the NASDAQ 100, and we are seeing small caps continue to decline. So always good to know where the key levels are. And even though we are seeing some of the dip buyers returning this morning and futures moving up a little, it does look like those key levels that were broken for the NASDAQ and the S&P 500 are definitely going to be retested today. So a very important day here in terms of the day-to-day price action for these major indices. From there, we'll be moving on to fixed income and commodities. Fixed income side, we are seeing a small rebound, a short-term rebound on in the TLT bond ETF. Nothing too major though. If anything, it was very much expected considering how oversold price was. And in terms of commodities, we are seeing gold continue to break down. We highlighted gold quite a bit last week. And in terms of oil, consolidation seems to be continuing. From there, we're moving on to the sector rotational model. Again, like last week, we'll be taking a look at the weekly sector rotational model just to get a better idea of the longer term rotation within the S&P 500. I have two subsectors of interest for you to go over today, and we'll end today's session with some bullish and bearish market observations. So, starting off with the S&P 500, and this was the key area that I spoke about being broken down, this 403 area. Now, initially, it did act as support, right? So if we take a look at the recent price action, price did break below 428. I came back to retest it after it broke below that area, failed, and went all the way down to 404 where it found support, came back to retest 428 again, very key area, this 428 level, failed again, and has been moving lower. Now, the one thing I will say when it comes to the S&P, the price action on this chart that we're seeing here is I don't really like it because if we take a look at last week, we saw on Wednesday there was a very positive reaction to basically the Fed mentioned that they don't foresee 75 basis point hikes in the future, and markets took that in a positive note, and we saw this huge rebound higher for equities, or reaching 428 and retesting the 21-day exponential moving average. But then on Thursday, markets moved lower quite significantly because I think the overall feeling was that the Fed wasn't doing enough to curb inflation. So very contradictory, and ultimately, I think it's too behavioral almost. It's too unpredictable and too choppy. So for that reason, I do prefer to stay out of the markets and just take a backseat approach, see how this is developing. And now that we have seen this break below 404, it does open the door for a further decline here. And in terms of possible targets, if we take a look at the weekly time frame, I have a Fib retracement drawing from pandemic lows all the way to all-time highs at around 480. And we can see here this 23.6 Fib retracement level, that was respected, right? We saw weekly bounces there. It was a weekly support area. Price eventually broke below that at that 404 level, and now broke this minor support area that I drew here. So in terms of looking at a future downside target, I'll be looking at the 38.2 Fib retracement level. And that coincides with the 380 area here, which I wouldn't say was a very obvious area of support or resistance in the past, but there was a lot of choppiness in the past around a year ago, or just more than a year ago. So further downside expected for the S&P 500. But then again, one or two huge fundamental catalysts could definitely see this analysis invalidated and a huge rebound here in the S&P 500. Taking a look at the Nasdaq 100, so very similar in terms of sentiment when compared to the S&P 500. Obviously, with the Nasdaq 100 being more exposed to growth names, it is going to be a lot more volatile. So what does that mean? It means that when we see these very short-term relief rallies, these relief bounces, the Nasdaq 100 will most likely outperform the S&P 500. But considering the fact that this is a very major, it's overall it's a downtrend. We are seeing the Nasdaq 100 underperform the S&P 500, and more recently priced at break below this 300 area, which was a key support area in the past, also a strong psychological level. Now, this morning we are seeing futures trade a little bit higher. We are seeing the major indices recover a little bit, but again, it just comes down to the fact that the decline here is caused by fundamental factors. It's caused by an interest rate hiking environment and inflation. It's caused by the war in Ukraine, and there's a lot of, and it's also caused by earnings not being as good as people originally thought they would be. So and a lot of investors were looking for this earnings season to be a fundamental upside catalyst, and that just has not been the case. So we take a look at the macro drivers that are running this decline. They do tend to be medium to longer term, whereas the shorter term reasons for bounce aren't really fundamental. They're more technical in nature. They're more due to the fact that price is now approaching an oversold condition, and we may see a short-term rebound before another move lower here. So that is the one thing you need to be looking out for the major indices. Yes, the overall trend is definitely bearish, but you want to look out for these short-term, and then there will be violent short-term rebounds higher, and that will provide much better risk-reward shorting opportunities here. So taking a look for possible targets for the Nasdaq 100, the next obvious area of support is at 267, but I wouldn't really view that as the next area of support, just because I do think there might be more minor support areas around 280 as well. So 267 definitely a possible downside target, but I think there's other areas here that Nasdaq 100 could reach before that, or could bounce off before that. Taking a look at the VIX. So VIX, this is actually one of the reasons why I think we may see a short-term rebound in the next few days, simply because the VIX has now been above this 30 level, this 30 threshold for quite some time. It is running into almost resistance, if you can call it that, around 35, 36. But, you don't often see volatility elevated above 30 for that long. We did see it, more recently in March. But overall, I do expect the VIX to eventually come down, and sooner rather than later, and that will most definitely be an upside catalyst, a broad-based rebound for equities. So, I will say that, even if with the VIX at current levels, we do tend to see a lot of systemic risk, we tend to see a lot of correlation, and that's not necessarily what you want to see when volatility is high, because what happens is whether it doesn't really matter if a stock's technicals or fundamentals are really good or really bad, there's almost no bifurcation, there's almost no difference there. So it just tends to be a whole systemic rise or whole systemic decline when the VIX tends to be at these current levels. And when it recovers from these levels and moves lower, we tend to see, no matter how bad stocks, technicals or fundamentals look, we tend to see a broad-based rebound. It's only when we start to approach this 24, 25 area do we start seeing differences in stock movements and less correlation. And that's what makes it a lot more, that's what makes trading conditions a lot easier, when there's actually less correlation and it's easier to diversify. So moving on to small caps, and you can see here, it's very obvious the underperformance of small caps relative to the NASDAQ and the S&P 500. We've spoken about this chart quite a lot, and the fib levels have definitely been respected. 23.6 fib retracement level at 210 provided a long-term area of major support, and price eventually broke below that, but declined exactly to 188, which is the 38.2 Fib retracement level. We saw price retest and reject on multiple occasions the 210 area, and eventually, more recently, price has now broken below 188 and is moving down with a lot of bearish momentum here. So, and for that reason, I don't really think, even if there's a rebound on the cards, if small caps are underperforming large caps, why? I don't believe there's a reason to really have exposure to small caps just yet. You know, small caps tend to outperform the large cap names in the early days or early weeks of a bull market. Right now, I think we're very far from that. So I do see further downside here for IWM, the Russell 2000 ETF. And the next downside target I have here is a 50% retracement level at 170, and that coincides perfectly with the pre-pandemic drop level here. So a lot easier, definitely a more easier chart to read, clear support and resistance areas, and does seem so far to be respecting its Fibonacci retracement levels. Okay, taking a look at the US 10-year, and yields have been on an absolute ripper, and more recently are now finally starting to pull back. But we have seen pullbacks like this. You know, they last for about 2 or 3 days, and then it just seems to continue higher. You know, and we know there's no doubt that yields are definitely have a lot of momentum behind them. That being said, if we take a look at the longer-term momentum, which is the blue histogram, we are seeing momentum is starting to decline here. So that is giving us clues to maybe there might be more consolidation ahead. I have mentioned in the weeks past that, you know, 320 to 325 basis points for the US 10-year was probably the target to look out for, and it might get surpassed, but overall, taking a look at the momentum starting to show signs of slowing down, we may be in line for further consolidation or maybe further pullbacks here for yields before another move higher. And that brings us to bonds. So obviously yields and bonds, they move inversely. So we'll take a look at bonds. You know, we spoke about this last week, that the TLT ETF was just breaking below through multiple areas of support. Broke below 122, came back to retest that on a weekly time frame, or as we can see over there on the daily. Failed on the retest, broke below that 116 area of support with a lot of bearish momentum. And yesterday, it did start to move higher as yields pulled back, set to open a little bit higher this morning. Overall, though, this doesn't change my outlook that bonds are fairly weak at the moment. The TLT ETF is fairly weak. And, you know, overwhelmingly so, the trend is definitely bearish. We may see these short-term pullbacks, and that's no surprise. I mean, price has now been in the oversold territory below minus 200 on the 50-period CCI. It's been there for a few weeks now. Around 6 consecutive weeks, you know, and almost 8 consecutive weeks. It wasn't for the other week where it did recover. So I do think that we're in store for maybe a short-term rebound here for the TLT bond ETF, maybe to retest that 116, 117 area. And if we do see a further rebound, we may be retesting 122. But if anything, this provides shorting opportunities. I'd be looking for bearish price action at those levels and to try gain exposure for a move lower here for TLT. So taking a look at the dollar index. So dollar index is now starting to lose some steam. We can see here momentum has been, you know, definitely decelerating. Still very bullish, still very much, you know, a lot of momentum behind it still, but that momentum is starting to decelerate after it approaches overbought reading a few days ago. And price, though, has made a new higher high. Not yesterday, the day before. Sorry, yesterday. As we can see here on the daily time frame, it did touch 104. Now, 104 was our initial target before we could start to see some consolidation. So I do expect to see some further consolidation at current levels. It's priced a little bit overbought, but you know, that's from a technical perspective. From a fundamental perspective, I still think the dollar is quite strong, because if you compare it to the other currencies, like, you know, the euro, the yen, maybe not as much, but also the pound, we do see that the Fed is hiking interest rates at a much higher rate compared to the central banks of those other countries. So the fundamental picture still supports for a stronger dollar. But until, we start to hear some news of those other countries really, or those other central banks starting to hike interest rates, I do think that we'll continue to see the dollar eventually break above this 104 level and continue higher. And taking a look at gold. So gold, is a pretty nice bearish setup here, if anything, because we have minor support at around 177. You can see price after making this huge spike to 193 did come back and treat 177 as support. We saw this false breakout, immediately reverse lower, tried to find support at 177 again, broke below it, and broke below its 21 and 55-day exponential moving averages. More recently, strong move lower to around 172, came back to retest that area and failed. Strong red candle there, as we can see. So this is a very bearish setup here for gold. I do think it'll be fairly short term because a lot of this is also based on the fact that the US dollar is losing momentum and gold does move inversely to the dollar. So I do think, I wouldn't necessarily be very long-term bearish or bullish on gold. It's very choppy. But I do think for now, there's definitely a short-term target here of this 171 area. And, like I said, because they move inversely, gold moves inversely to the dollar. If we do start to see the dollar pull back somewhat, gold might find support at 171. This is a major resistance area in the past. It could turn as support and we could see a short-term move higher. But for now, at least for the next few days, 171 is going to be the target price here. And crude. So crude, quite a boring chart that we have here again, but as you can see, further consolidation, nothing major happening. Price is continuing to find support at around this 96 area, and it is running into resistance at around 108, 110 or so. Last 2 days have seen a significant pullback here in price, but overall still within its consolidation range. And as we know with oil, energy stocks tend to move in tandem with oil, as you can see, and energy has definitely lost a lot of momentum during this consolidation phase. So if we do see oil continuing to decline back to 96, I do expect this week for energy stocks to consolidate further or pull back slightly, but a breakout here in oil could see energy names also breaking out and continuing higher, and they have been very strong in 2022. But overall, nothing exciting happening, but something you have to look at every day really to see how it impacts the energy sector. And I do think it'll require a strong fundamental catalyst to change the supply and demand dynamics of oil, which will see a breakout or a breakdown here in price. So taking a look at the sector rotation chart, again, this is a longer term sector rotation chart. It's a weekly chart, whereas I normally use a daily, but just because there's so much noise and so much choppiness, sometimes it's best to take a step back and look at the longer term trend. And, this really does further exemplify what we have been speaking about for the last year or so with defensive leadership, right? If we take a look at the leading sectors, we have utilities, we have staples, and we have healthcare. These are very traditionally defensive sectors, considered very much value sectors as well. And we are seeing rotation into these sectors, providing leadership, especially now with staples starting to find a lot of momentum here and growing relative strength. Taking a look at energy, even though price hasn't declined all that much, actually, energy has lost a lot of momentum with oil consolidating in the last few weeks. So that is why we are seeing the sector, move down the way that it has been. But it is still, that's not necessarily a bearish sign. It just means that it has lost that momentum that it had a few months ago. Taking a look at the lagging sectors here, we have discretionary, we have technology, and we have financials starting to show some sign of improvement. But again, not a whole lot. I'd like to see for these sectors to really rotate into the improving categories. And what we'll most likely see then would be a rebound in the major indices, because these sectors are very much heavily weighted within, especially the S&P 500 and even the NASDAQ 100 in terms of technology. So, a rebound in these sectors will definitely see a huge improvement here in the major indices. Okay, so taking a look at some sectors of interest, and the first one that I have for you here is technology. And technology is a sector that we actually haven't looked at for a while. So if we draw some lines here, we have this 142 area between 142 and 140. This was definitely acting as support since March, right? We saw price has reacted to this area on multiple occasions. But more recently, it has really struggled to find momentum or huge bounces from that area, running into resistance at around 148. And eventually, we did finally see this breakdown of 140. We saw that yesterday. So a lot of bearish momentum here. As we can see, it's growing longer-term bearish momentum. And if we take a look at the weekly time frame, we have another fib retracement chart from pandemic lows to all-time highs at just shy of 180. Again, price has definitely respected the 23.6 fib retracement level in the past. But as we can see, that has definitely been broken to the downside. And now price is at the 38.2 fib retracement level. Overall, though, just looking at the bearish momentum and the rotation out of technology that we have seen in the last few months, I do expect this level to be broken and eventually price to decline to this 50% fib retracement level at around this 122, 124 area. And that has acted as resistance in the past as well. So definitely a good longer term target in my opinion. That being said, with price approaching an oversold condition, I wouldn't be surprised to see short-term retracement higher to retest that 142, 140 area. And I'll be looking for bearish price action before looking for potential shorting opportunities. Taking a look at the healthcare sector. So like I said before, healthcare is a very defensive sector, and it is part of the leading category. So the price action, though, over the last few weeks, it has been quite bearish, and that's no surprise. Obviously, there was a systemic decline with volatility being as high as it was. Price did manage to break below this 131 area, came back to retest it, failed, and is now moving lower with a lot of momentum. But however, I do think where price is at now, it is worth noting because this is a major support level. If we take a look at the weekly time frame, price is now closing in on this 125 area, and this is an area that healthcare has found support multiple times in the past. And also with the fact that healthcare is a defensive sector, and if you have to be positioned within a handful of sectors in the S&P 500, healthcare is one of them. It's definitely one thing to note, and I'd be looking for bullish price action near this area for a move higher in the sector. Possible upside targets would be at around 136, 137. As we can see, it did find resistance in the past there, but also around 144, 143 all-time highs. I don't know if equities have that much momentum, or healthcare even would have that much momentum to reach that high. But overall, I do expect a bounce at around this 125 area. So taking a look at SMH, which is the semiconductor ETF, daily time frame shows a clear bearish trend, right? But you can see here yesterday's price action was even more bearish. We saw this break below 225, 226. And that is quite significant in my opinion. And if we take a look at the weekly time frame, we have another fib retracement area. Not a perfect fib retracement chart because price, while it hasn't reacted perfectly to these levels as some of the other charts have, it has, it has reacted near that area. Like if we take a look, for example, at the 38.2 fib retracement area, price has acted as support just below that at around 220, even though the 38.2 level is at 230. But clearly a major support area at around 220, and price has now broken below that area. So I do expect to see this a retest of this 230 area, and a failed retest would open the door for a good bearish opportunity and a further decline here to the 50% fib retracement level at around 205. And the other subsector of interest that I have for you today is the home builders ETF. So I've been bearish on home builders for quite a while. That being said, we have seen a lot of consolidation in the last few weeks. Price did form this topping formation, eventually broke below the $70 area, came back to retest it, failed, and moved perfectly to our next downside target that we've spoken about a few months ago at 60. And after a decline to 60, we can see here that it has found support on multiple occasions, but there hasn't been any momentum to really facilitate an upside move, an upside break of structure. We can see price is still below the 50-period exponential moving average, even though it's broken above the 21-day exponential moving average. It hasn't really been able to stay above the 21-day either. So I do think there's a possible breakdown on the cards here, especially if you take a look at the last 4 weekly candles. Major rejections of 63, all 4 of them. So that's a very bearish sign. And, a break below 60 is expected over the next week or 2, in my opinion. And should we see a break below that level, I'll be targeting the $50 level, which coincides almost perfectly with the pre-pandemic area and also acted as support in the past. Okay, so moving on to some bullish market observations. First one I have for you is Walmart. Walmart is part of the staples sector. We know the staples sector is very strong at the moment, or on a relative basis, at least, to the S&P 500. And we saw some very interesting price action in the last few weeks. We saw this very strong move higher to 146 resistance. I did originally think this was a good bearish opportunity, and that wasn't validated after price initially did move down, but found support as 21-day exponential moving average and moved higher with a lot of momentum. And then again at 150, we saw another fight between buyers and sellers, with price failing to really break above that area. And again, that would have been another bearish opportunity, in my opinion, or another good risk-reward bearish opportunity, considering how overbought price was. But again, that wasn't validated when price broke above that area and rallied all the way to 160. Now we have seen a further pullback, broke below its 21-day exponential moving average. And yesterday, though, the price action was quite positive. We saw a huge bounce back to this 150 area, set to open at around 152. And what we're looking at here is a classic, retracement to 55-day period moving average and a bounce higher here. And especially with the fact that it's part of the staples sector, it does give me a bit more confidence that we may see a continuation higher here for Walmart. And I'll be looking at around around 160 as a potential target over the next few weeks. And taking a look at Monster. So Monster is an interesting one because they undershot their earnings, didn't perform as good as expected, but price has maintained a key level here. So we saw this rebound after, let me fix that. Apologies. There we go. Yeah, so we saw this, strong decline all the way to around 72. And then price did eventually rebound higher, running into resistance at 82, which was a previous support level, managed to break above that, retested it, and bounced higher to 88. And more recently, we have seen another retest of this 82 area, but price so far is holding firm. And I do think this provides a good risk-reward bullish opportunity for a move higher, initially to revisit 88, but possibly even higher than that. And you could even be looking at around the 90, 95 area as a potential upside target. And again, Monster is part of the staples sector, so it does give me that confidence that it could be a potentially bullish idea. And where it's trading at now, it does provide a good risk-reward bullish trade, in my opinion. And if price does break below that 82 area, you could immediately close that trade for a minimal loss. So a good risk-reward bullish opportunity here for Monster. And taking a look at Duke Energy. So Duke, part of the utilities sector, actually, And utilities, again, another defensive sector. We saw this break above 107 or 108 resistance, strong momentum heading all the way to 116, and price did run into a lot of resistance there. Eventually pulled back all the way to this 107, 108 area, and is now bouncing higher with some decent momentum. So the fact that it hasn't broken above its 21-day exponential moving averages is somewhat concerning, but overall, I still think there's still some potential for a rally back to this 116 area. If price can stay above 107, this would be the key area that price will need to stay above for me to maintain my short-term bullish view here. And if we take a look at the weekly time frame, it's probably paints an even better, more clear picture of major resistance at 108, price breaking above it, coming back to retest it, and bouncing higher on an intra-week basis last week. Okay, so the first bearish market observation that I have for you today is Newmont Corporation. We can see here price was on a strong rally all the way to 86 and has lost a lot of momentum and pulled back all the way back down to the support area at 71. Now, this stock does have a high correlation to gold prices, and we are seeing now with gold moving lower, there has been a breakdown below the 71 area of support, and probably a very short-term trade, very short-term setup, like I mentioned for gold a few minutes ago. But the next support area here for Newmont is at around 65. So that would be the target that I would be looking at here in the next few days, even by the end of this week. So taking a look at Walgreens, strong bearish trend on the daily time frame, but price action has been quite choppy. I will say, it hasn't been the most easiest chart to read, but I do think there's an opportunity here with price breaking below 45 and coming back to retest it, failed on Friday, failed to move above its 21-day exponential moving average yesterday. And this does open the door for a good risk to reward bearish opportunity. And in terms of the next support area, you'll be looking at the weekly time frame. Again, very choppy in terms of price action, but $40 does seem to be a key area of support in the past, and that'll be the downside target that I would have. But again, probably more of a medium-term trade, a couple of weeks or so. And next we have Pinduoduo. We can see here strong break below 49 or $50 support. Price came back to retest it, failed on multiple occasions, came back to retest its 55-day exponential moving average more recently, and just didn't have the momentum to break above it. We are seeing price move lower here. So momentum looking quite negative very quickly, and this does provide a good bearish opportunity here. I'll be looking at a target of around 24, which was a previous swing low a few weeks ago. In taking a look at Zscaler. So Zscaler, part of the technology sector, which we know we do have a bearish view on. And interesting chart here. If we focus on the weekly time frame first, we saw price break above this 155 area of resistance, found support on multiple occasions, and then moved higher all the way to 365, reversed lower, and has now broken below 155. And if we take a look at the daily time frame, I will say it does look a little bit oversold, but definitely 165 support was the price point that I was referring to, not 155. Price is now at 155. But I do think price now is a little bit too oversold for this to be an actionable idea. But I do think it should be on your list, on your watch list, because if we can see a retracement back to around the 165, 170, or even 180 area, which was a previous swing low on the daily time frame, I'd be looking for bearish price action at that area to, for a good bearish risk to reward opportunity here. And in terms of possible targets, 118 would be the next key area of support that I would be targeting here for Zscaler. Okay, and with that, that is all I have for you today. I know we did run a little bit over schedule, but there was just quite a few ideas that I wanted to share with you today. And yeah, I hope you have a great trading week ahead, and I will see you next week. Goodbye.